Um, my name is Andy. I am the Director of Events with the HBA, and I am going to introduce you to Nathan Young, our 2020 Board Chair for HBA. He's the owner of Nathan D. Young Construction and Mods Construction, and he is our moderator for today. So Nathan, I will send it to you.
Great, thank you. Welcome everyone, and thank you for joining us for the first ever virtual mid-year housing forecast presented by Northwest Natural as part of our Connect and Build webinar series. This has certainly been a year of firsts. Words like uncertainty, stressful, and pivot seem to have become regular parts of our vocabulary. But for many of you, these are giving ways to words like creativity, rethinking, and connecting. HBA's new Connect and Build series is intended to help all of us have the tools and info necessary to go beyond adapting. I'd also like to extend a special welcome to the elected officials attending today. Thank you for your service and leadership to our region, especially through these challenging times. Thank you also for your ongoing engagement with HBA as a partner in working through our region's housing challenges. My name is Nathan Young, and I'm president of the Home Builders Association of Metro Portland Board of Directors. I can tell you that one of the bright spots over the last several months for the HBA has been the support of our longtime partners, especially Northwest Natural. Having such a steady partner as Northwest Natural has enabled us to host events like this that benefit the housing industry. It also helps us to inform and educate those who impact housing policy and production. Northwest Natural's unwavering support has been paramount for us to provide quality events, both physical and now virtual, that you have come to expect from the HBA. At this time, I'd like to introduce John Frankel of Northwest Natural. John is the Senior Manager over Marketing and Channel Development, and of course, a longtime personal friend of all of ours. John?
Hi, first of all, I'd like to say we're grateful for our partnership with the building industry and for this opportunity to sponsor events like this. In these times, you really can't overstate the value of information, and we know how important it is that we make informed decisions. These type of opportunities for us to all learn more about what's happening in our industry really help us to drive our business forward. Thanks again for our opportunity to sponsor this, and again, looking forward to this presentation.
Thank you, John. And please share our thanks with the larger Northwest Natural team for all you have done and continue to do for the HBA and housing industry. We are delighted to have all you here today to hear Josh Lehner give us a mid-year housing forecast and help us make sense of this crazy time we find ourselves in. Josh is an economist for the state of Oregon and develops the state's quarterly economic forecast, including outlooks for employment, income, and housing. Josh also acts as the state de facto vice economist by forecasting revenues for the Oregon Lottery, Oregon Judicial Department, and state marijuana and tobacco taxes. Josh will be speaking for about 20 minutes, which should leave us about 15 to 20 minutes at the end for questions. Feel free to use the Q&A function, not the chat function, which should show it at or near the bottom of your screen, to type in your questions at any time during the presentation. We will get to as many as we can after he concludes, and we promise to wrap up by 9:30. And now I'll turn it over to Josh.
Morning, everyone. Thanks for having me, Dave, Home Builders Association. It's a pleasure to be back in front of you guys. Unfortunately, I wish it was better news overall, just given where we are in the cycle relative to some of our past discussions we've had in recent years, where we're concerned about, kids in the basement and household formation rates and things like that. In the aftermath of the Great Recession, it took a really long time to work through all that sort of stuff. And the last decade has been it'd been long, but it'd been a slow expansion. But we'd finally got to a really good spot economically and from a housing and home ownership perspective. And then here we are. Pandemic came upon us basically overnight in a matter of weeks. We shut down the economy and we're in a severe recession. And today, things are getting better. Things are better than expected, particularly in your industry. But our initial thoughts in our office were that, we were going to see apocalyptic numbers, and that just hasn't come to pass. We've just seen really bad numbers. So things aren't good, but they're not as bad as expected. So I guess whether that's a half full or half empty glass, that's kind of up to what you were expecting in your particular business, in your living situation and the like. And today we're at a bit of a crossroads. One of the reasons things haven't been as bad as expected lately is due to the federal assistance, right? And right now we have Congress debating new packages, new relief packages for small businesses and for households. The previous versions that went through, the CARES Act in particular, have been really beneficial to the overall economy, saved millions of jobs, kept households from falling behind on things like mortgage payments and utility payments and all that sort of stuff that we care about. And so that permanent damage to the economy has been, sort of minimized so far. But we're going to need more assistance, right, until the pandemic has subsided. The virus is in control. This is not, a trade-off between the public health side of things and the economy. It is not an either-or discussion. It is a neither or both discussion, right? We cannot have a full economic recovery until we have full clearance on the health side of things. And so that is the biggest risk, is kind of that permanent damage that accumulates during the pandemic. How many businesses go under? How many people are permanently laid off instead of temporarily laid off? How much income losses do we see and the like? And that's what we're really, really concerned about. Obviously, the health side of things, we need to get clarity there before we can do the full decomposition of all the economic fallout associated with that. And you can see here, this first slide is a chart comparing recessions in Oregon. These are job losses. You start at the left at 0%. That is how many jobs you had prior to the onset of recession. As you drop down, that's the severity of the recession. You can see the red line for the current cycle. It doesn't look anything like what we've seen in past cycles. Not only was it the deepest recession on record in Oregon, it came upon us overnight and we shut things down immediately. Now we're doing a little bit better. Right now, we're kind of at the depths of the Great Recession, or the depths of the early 80s, timber industry restructuring recession, that sort of severe economic cycles we've seen in the past. That's where we are today. Our timeline for getting back is kind of following that blue line there in the middle, the 2001 recession, the dot-com recession. That's kind of what we're thinking, 4.5-year cycle here, where, mid-decade we'll return to economic health. It's going to take a while. Because the health side of things isn't better. And in fact, we'll talk about here in a minute, the health side of things seems to be worsening, which increases the risk of a protracted recovery, increases the risk of a double dip recession and the like. And until the virus is under control, we will not have a full economic recovery. All the stuff we've seen the last couple of months, the reopening of the economy, going out to eat just a little bit, right? That's the easy part, right? That was the easy part of the recovery. Now it's a lot harder. And so we're going to see just exactly how strong and how quickly we can grow the economy, how large the assistance packages are to businesses and to households. And I think it's important to keep in mind that the risk of these permanent economic damages are quite large. I don't think we've seen a ton of it yet. We're seeing some businesses go under. A lot of bars and restaurants have closed already, and there's more to come. But broadly speaking, some of these other sectors haven't seen as large of an impact. But they're still at risk. This chart kind of shows you our thinking of which sectors are more at risk here in Oregon. On the x-axis, going left and right, is the small business risk. The reason we would highlight this is because small businesses, face different constraints or different issues than large businesses. They don't have access to the deep capital markets. They can't issue stocks or bonds or take on debt as easily to tide themselves over. They can't just, say stop paying a dividend. And retain those earnings to help themselves over as easily as maybe some large businesses can. And then on the vertical axis up and down is kind of our economic shock. What kind of damage are we thinking economically from consumer demand and the like for some of these potential business closures? Now, this is just highlighting risk. It's not our actual forecast for number of businesses that will close. But as you guys know, as you went through, this can have a big impact on the industry. If we look at the last cycle, the housing boom and bust and the Great Recession, right? Construction in Oregon lost 4,000 firms. 4,000 of your neighbors or your colleagues went out of business. 26% of all construction companies closed in Oregon, and we lost 35% of our jobs. And then it takes a while to rebuild that stock. And in fact, it's taken all of the 10 years since the housing crash to really rebuild that stock of employment and rebuild that stock of construction companies, right? And so that's one of the reasons why, construction is maybe more at risk because of all the subcontractors and all the small players within the sector, that potentially is maybe more at risk than some of the other industries more reliant upon large companies. But that's basically going to be really determined by industry demand, which industry demand for you guys has been really good, relatively speaking. Construction and housing, home buying in particular, has been strong, or at least has recovered in the last couple of months. Certainly saw an impact immediately. People got scared. They pulled listings. They pulled stuff off the market. People didn't go out and tour homes. They didn't buy homes, in March and April. But since then, it's come back. And if you look at the realtor data, right, not only are home sales back, the pending numbers, the pending home sales are basically at a, not quite an all-time high, but certainly the highest numbers we've seen in maybe 3, 4, 5 years in the Portland region. And as long as that home buying strength continues, then new construction activity will continue at about the same pace, right? Because we got to keep up with that supply. You keep our supply up with the level of demand. And so as this construction activity has come back, the levels comparable to a year ago, both on the home buying and the new construction activity, that means employment has done well at the same time for the construction industry. Here's a similar style chart, just looking at construction employment by recessions here in Oregon. And you can see, this doesn't necessarily look like the past cycles. Again, coming off of the strong 1970s and the strong housing bubble years, right, there was large imbalances, right? There's a lot of construction activity that came off due to the severe recessions, and we're not in that type of cycle. We did not have overbuilding in the construction industry in the past decade. We know that. In fact, we've been underbuilding. And so far, fingers crossed, right, for housing and for construction, this maybe looks like one of the more mild recessions. We know we're not in that severe cycle like we've seen in the past. And I think there's 3 main reasons for this strength and 3 main reasons for optimism moving forward in the years ahead. The first one, if we're going to be honest about it, particularly on the home buying side of things, is this has been a recession that has largely impacted low-wage workers the most. They've borne the brunt of the recession, when it comes to leisure and hospitality, some types of retail, and sectors like that have been impacted the most. And so we see workers in these low-wage jobs suffer the most. Now, people in middle-wage jobs and high-wage jobs have done better. They're not immune, but they have done better. And these are people that are predominantly homeowners, whereas some of the low-wage workers are predominantly renters. And so the nature of the cycle has hit renters more than it has hit homeowners, and particularly prospective homeowners, which means that housing demand has been propped up a little bit better due to who has been impacted the most. Now, that doesn't mean we're not going to see some more high-wage workers laid off. We're starting to see this initial shock to the economy. It's important to keep in mind that the shutdowns that we saw with the first spike of the pandemic a couple months ago, that's a first shock to the economy, and we're still seeing second and third order effects associated with that. The shock isn't done reverberating throughout the economy. Some of these high wage jobs are just now beginning to be laid off, just now becoming permanent. And so I think, we're not immune to this risk, but so far, this is one reason why housing demand has remained strong, in particular, when you combine it with reason number 2, with the low interest rates, right? These record low mortgage rates mean affordability is not the issue that it can be at other points in the cycle, right? For every 1 percentage point drop in the mortgage rate, that means home buyers can afford 10% more home, for 10% more house, right? And so if you're looking at a $400,000 home at a 4% mortgage rate, at a 3% mortgage rate, you can afford a $440,000 home, and that monthly payment would be the exact same. And so this drop in mortgage rates is expected to last. The Federal Reserve is signaling that they're not going to raise interest rates until the economy is strong. And in particular, they're not going to raise interest rates until inflation actually picks up. Historically, the Fed has raised interest rates in anticipation of future inflation, but now they're signaling, well, we're going to wait until actual inflation picks up above our 2% target on a sustained basis. Then we will start raising interest rates. Whether this comes to pass or not, we will see. It is another shift in the way the Federal Reserve is communicating and indicating their reaction function, the way they respond to the economy and the outlook. And right now they're saying, we're not going to raise interest rates at least for a couple of years. That's as far as they project their forecast, a couple years down the road. Wall Street investment firms are saying that's going to be sometime in 2025. Our main economic vendor, Global Insight or IHS Markit, they're saying their first rate hike in the forecast is 2027. So regardless of where this comes into play, whether it's 2023, 2025, or the like, we're looking at low interest rates for the foreseeable future. So if we have high wage earners less impacted by the cycle, plus low mortgage rates, and our third primary reason for strong housing demand, if I can get the slide to work, demographics, it means the industry should be doing well or relatively well for the foreseeable future. I think this is something, we've been talking about for a really long time. Since I think, I was talking, we were talking about this for at least 5 to 10 years at this point, the impact of millennials aging into their home buying years. And we're finally here. We're done talking about it. We're finally at this point where this decade, millennials will fully age all the way into their 30s and their 40s, which are prime home buying years. So for the housing industry, this is really, really good news. We're finally here. This is one of the best demographic decades you could ask for, both on the front end with the early 30s being, prime first-time home buyer years, and then your early 40s being when people spend the most of their income on housing. It's a combination of maybe trade-up buyers, have young families, they're moving to the better school district, furnishing their homes, have growth in income as they're kind of in their mid-career years, so they're getting promotions and raises at work, all that sort of stuff. It's all happening this decade. So with a backdrop of strong demographic tailwind for home buying and housing and home ownership, this is primed to be a good set of years for the overall industry. So I think these are the three main reasons why the industry is doing well, or relatively well, better than expected in recent months, and they should continue moving forward. But the outlook is not without risk. And the first and the main reason for the risk is that the pandemic hasn't gone away. And in fact, it's worsening, right? The caseloads are up nationwide. In a lot of spots here in Oregon, we're seeing record number of cases in the last month. And it's not just due to more testing, right? You can see the red line, the positivity rate. Our positivity rate has gone from 2% of tests coming back positive to 6%. So it's increase in more tests is one component, but we're also seeing an increase in the positivity rate, which means there's fundamentally more community spread, and the virus is more prevalent than it was previously known. And so that is a big component here. And so this puts everything at risk, right? Even if it doesn't force a formal lockdown again and a shelter-in-place style policies around the country, informally it does the same thing. People get scared. Businesses don't hire. They don't recall their workers. They're not trying to expand their footprint due to the uncertainty. Households pull back. They're not going out to eat. They're not spending as much money because they're worried about the spread of a deadly contagious disease, right? And so this has the potential to really protract the recovery, to really, even at a worst case scenario, send us back into a double dip recession where we get this growth this summer, and then all of a sudden we see another downturn, another leg in the cycle due to the health situation deteriorating, or due to the fact that we don't receive more assistance for our household and firms, and we see another round of closures and permanent layoffs, right? So the risks are still there, right? We have all these good economic news, good structural news, for the housing industry in particular, but the normal recession dynamic, the potential for a double dip, the pandemic hasn't subsided. In fact, it's getting worse. Those are all really big risks that can't be ignored and certainly impact the outlook moving forward. And beyond that, sort of the normal recessionary dynamics haven't really come into play yet, but our office is worried about that. We think they may, and certainly will, in the years ahead. It's important to keep in mind that it feels like years, right? It feels like it's been a really long time since this started, but it's only been a couple of months. It's only been a few months since the pandemic really ensued here in the US. And this is a multi-year recovery process, right? The cycle will last years, and we're only a few months into it at this point, and some of the normal recessionary dynamics haven't really been felt. And so we're expecting them to in this year and next, as the data starts to come in. We will see migration slow. People move to Oregon in good times and bad. but the growth is pro-cyclical. They follow the jobs. So as the job opportunities dry up, we're expecting migration this year and next to be significantly lower than what we had assumed pre-pandemic in our forecast. Right? We've lowered it by about a third. And so this will hurt housing demand over the medium term. Maybe the first leg will be it'll hurt rental households more, or rental properties more, because who moves is mostly 20 and 30 somethings, young people in search of job opportunities. But overall, that'll impact the housing market and potentially pricing, soften pricing a little bit moving forward. And then more importantly, would also be incomes, right? So far, incomes have held up due to the recovery rebates and the expanded unemployment insurance benefits, right? Incomes are actually up the last handful of months, not down like you would normally see in a recession, but this is due to that federal aid. You can see our forecast here. We don't have big recessionary declines built into personal income in Oregon, in large part due to the federal assistance. But you can see we've revised down our income forecast substantially. So instead of growing, instead of seeing solid year-to-year growth in income in Oregon, we're now expecting income to be relatively steady. And eventually, this means in an inflation-adjusted terms, in real terms, our income is going to drop a little bit for households. And so this will impact consumer confidence. This will impact, ability to pay and the like. And so this too will eventually weigh on some consumer spending items. And so this, again, we're not having a massive impact from this yet in the data, but it remains a risk to the outlook. Now, one wild card, and I think is largely an upside wild card for Oregon, is working from home and actually putting to use, some of these home offices that we have that have been largely used as storage units, or, where we print things or something like that in recent decades, but we're putting them to more use or better use, certainly in the pandemic. And so in the short term, we need to separate the short-term trends with working from home and the long-term trends from working at home. In the short term, this is all about whether you physically can work from home and avoid the offices, right? And for about a third of us, we theoretically can work from home. We kind of just need a laptop and an internet connection, and we can do a lot of our work. Not everything, but we can do a lot of our work. But there's 2/3 of workers that can't do that, right? You can't work from your home and be a line cook or wait tables or clean floors or drive a truck, or there's 2/3 of workers can't do that. But a third of us tends to be more white collar, professional, office-based work. You can do a lot of stuff. And so, to the extent that we're able to do that, we certainly are. But over the long term, most of us will be recalled to the office. We'll go back to work. The question is, those long-term trends, how do they shift? I think they're going to continue to increase. And long-term working from home is largely about people living where they want to live, which is really good news for Oregon, right? This should increase migration relative to some normal, pre-working from home baseline. All of Oregon, whether it's Portland or Bend or the coast or the gorge or wherever it may be, all of Oregon does well on working from home. And so I think this will be an upward risk to the extent that we see more of this activity in the future. It'll be a positive boost for Oregon's economy, positive boost for housing demand, and potentially, if we really do telecommute more and we have some more remote workers, we could see an increase for, say, single-family homes relative to multifamily. People would live a little farther flung, maybe in the suburbs or the exurbs or in more rural areas. That is one possibility. There's probably some truth to that. We're not seeing that in the data at all yet. Right? There's a lot of speculation, but none of the data indicates that we will see that, or we are seeing that, but potentially we could. And if that does come to fruition, that would be another source of housing demand for your industry moving forward. So if we put it all together, I think, our office's first forecast that we put out a few months ago had substantial declines for construction and housing activity, right? Due to the pandemic, due to the severe nature of the cycle, due to the drop in migration and the like, and that just hasn't come to fruition. And I think the reason we haven't seen that is largely because these structural forces, the demographics, of the nature of the cycle, of the interest rates, has really propped up that demand, and it's offsetting the cyclical issues, at least so far. And so I think the expectation should be that the industry doesn't see massive declines. We know we didn't overbuild. We know we're not in the bursting of a bubble situation. And so we should expect to see a couple soft years on the home ownership side, on the home buying side, relative to large declines. I don't think that is what it is and what the baseline should be. And I've just brought this chart back, something I shared with you 18 months ago at the 2018 forecast breakfast at the convention center. Hopefully we can all go back to something like that at some point in the future. I just used this chart again. I think this should be an appropriate outlook. I haven't updated it. You can see the recession's in the wrong year. I just said maybe we'll have a recession, 2 years down the road, 3 years down the road. Well, it's here today. You can see the combination of the aging millennials into their home buying years really offsets some of the cyclical weaknesses of lower migration and income impacts. Now, what would I change about this forecast today relative to some of the hypothetical recessions I built in a couple years ago? Would be a larger impact on the renter side. The reason the renters are less impacted here than the homeowners is kind of that ability to pay and people switching, putting off home ownership until they're more secure in their economic situation. Well, I think one of the impacts on the housing market today with the recession are young people might be moving back in with their parents. If you have a lease that came up in the last 5 months, and you have family members nearby or close friends or the like, you might not be renewing that lease just due to the uncertainty of the pandemic, right? And so I think in the immediate term, the rentership in the rental households might be impacted just as much due to the uncertainty of the economy. But other than that, I think this flavor and this nature of this outlook remains intact, where we should expect a couple soft years, stable demand, maybe down a little bit, but not significantly so. But longer term ongoing growth. It's important to keep in mind that I don't think these housing supply constraints that we've talked about so much in recent years, they haven't gone away. Maybe the labor side is getting a little bit better. And by a little bit better, I mean we have more unemployed people, which is bad news for workers, better news for businesses trying to hire more workers as demand returns. But other than that, we're facing some of these supply constraints that we have. Those aren't going away. What is new since we last talked is the state has passed a couple new policies that, fingers crossed, will boost supply in the years ahead. They're at least designed to boost supply. It's not a silver bullet. They don't happen overnight. This is a multi-year, let alone a decade process to see whether these actually do boost housing supply in our communities. The first one being duplex legalization, right? Not the elimination of single-family homes, but changing the zoning to allow for more types than purely single-family homes in a lot of our areas. And so this means more townhomes potentially, which would increase the supply. And then the other one is now just being, we're in the middle of this process, but updating and trying to come up with true regional housing needs analysis work. Right now, you do it city by city or county by county. But this potential process that we're in the middle of working on would look at a true regional demand perspective and then ensure that the cities have the adequate capacity and the like to meet the true regional housing needs. So these are things that could potentially boost housing supply in the years ahead, which is much needed, of course, for the state of Oregon. With that, that's everything I had prepared. Here's my contact information. I'm always happy to chat, either now or in the future. Feel free to reach out, send me an email, a text, follow along on our website. I'll be posting these slides and everything here shortly this morning to your website you see there. And with that, I'm going to release the screen, and I think we'll move into the Q&A portion of the morning. Thank you. There's a question about if there's no further government stimulus and there's no changes regarding evictions, what will that have on the economy? I think that's a big risk in terms of the household side of things. If there's no more expanded unemployment insurance benefits and we still have double-digit unemployment, that's a big drop in consumer demand, a big drop in consumer spending. And we're going to see a lot of those lower income households that have been disproportionately impacted fall behind on all sorts of payments. All right. And so I think that's a tremendous risk to the economic outlook. And then therefore that's going to mean more property owners falling behind on their mortgage payments and deterioration in commercial-backed securities and all that sort of stuff that would ensue. And so I'm not sure we're going to get that combination of no evictions plus no assistance, but we will see. But it's certainly on everybody's radar.
Hey, Josh, this is Dave. Just another one that might be good is the institutions were hit really hard financing, and that really is one of the other factors. What are you seeing now in terms of banks and lending institutions? Obviously, on the personal side, the homeowner side, rates are low, and so they're there. But especially given the volatility in the commercial market, not knowing how commercial real estate is going to be, what are you seeing on the banks and lending institutions side, and any projections there?
Yeah, the lending has been critical, and that has been one of those supply constraints in the last decade. And we don't have updated information on that. I'm not hearing anything from some of our contacts saying that they're really pulling back. And I think, the home sales data and the permit data will be encouraging for them. But, most of the banking surveys, the normal stuff we look at are quarterly, and we don't have second quarter survey data from loan officers and FDIC, the data that the FDIC collects on the regulated banks and the insured banks. And so we don't have a good idea of exactly what has changed, but I think the ongoing strength should be, fingers crossed, helpful, obviously.
I see another question here. It says, talk about the shortfall in city and state tax dollars and how that may affect us in housing. So just the tax revenues that are coming into local and state jurisdictions.
Yes, state and local governments are in need of assistance if they're not going to have large declines and layoffs and pullbacks in their services they provide to citizens. Right now, they have received no assistance. And they're trying to, there's been a little bit of coronavirus, like you can, if you have additional costs due to the virus itself, then you can get that reimbursed, but actual broader aid to help with general budgets, no. And so I think that's a big risk. We haven't seen a ton of layoffs in the public sector yet, but I think those will come, certainly would come. We've seen teacher layoffs, but that's a little bit different with the shutdown of schools, and there's some other factors going on there. They're not permanent layoffs yet. But so I think that is something to keep in mind. The public sector is, depending upon where you are in the state, it's 15 to 25% of the regional economy. And while it doesn't tend to grow as quickly as the private sector, of course, it is a stabilizing factor. And so some of our communities that are maybe more at risk associated with that. But of course, public sector revenues are all about private sector activity. So as the private sector has tumbled with a recession, we know that the public sector is next. And I think, the more assistance there will help stabilize the economy.
Yeah. What about, I touched base really on the commercial side. And while our industry focuses on residential, some of that does cross over, whether you've got mixed use or there's a lot of residential applications that cross over, but given the impact to retail operations, given the impact to offices and how much they're going to continue in some kind of remote environment, whatever, there will be an impact on the overall kind of real estate market. And I realize this is more of a residential focus, but anything that you've been looking at or doing on that, any insight you want to give on that?
Everything is downside risk for commercial real estate. I don't think there's any positive news, to be honest. In the immediate term, it's about vacancies, businesses going out of business, right? So vacant storefronts, vacant warehouses, and the like. Potentially, the more that we see on that, the more it'll weigh on lease rates, or and then that would have a knock-on effect on property tax collections, both in the ability to pay this year and in valuations in the years to come. So I think there's a lot of downside risk associated with commercial real estate. One thing is like, well, what about, increased demand for co-working spaces? Well, it's like almost by definition, co-working spaces have less square footage per employee than a normal traditional office would. So that's still not necessarily there's maybe a silver lining there for a certain small segment there, but overall, it's I think there's a lot of risk on the commercial side, and it's all tied to business closures, and then you have to get those lease rates back up, the vacancies back down before new construction pencils out. So I think you're looking at a multi-year process there, even in a good situation, unfortunately.
Have you had a chance to check on evictions? Obviously, there's been a lot of work, and both local governments and others have kind of put a pause on certain evictions and all that. But have you been tracking that at all and kind of seeing? I know I was talking with one of our members who has a lot of rental properties, and I think they were saying that about 11% of their renters were not paying rent, and claiming COVID as a reason for that. So, which is a pretty high percent, and as we were just talking about a little bit ago, is going to affect commercial real estate at some point. But what are you guys seeing in terms of eviction notices, or how that's affecting residential tenants or even commercial tenants?
So it's hard to have good data on this. There's competing reports that come out, every month, when it comes to the percentage of renters meeting rent or making payment or making at least a partial payment, right? So there's some that say that there's not an impact or it's comparable to year ago levels. There's always some segment of our society, that are really struggling to make ends meet, and they're at risk of eviction. Whether that's increased or not is hard to tell. Some surveys say yes, some surveys say no. There's a new experimental survey that's been going on for 12 weeks now from the Census Bureau. It's a weekly survey across the country. And that shows Oregon, at least the people responding to this survey in Oregon, both on mortgage payments and rent payments, we've not seen a deterioration of people making payments, at least based on this survey result. So fingers crossed that continues. I think a lot of that has to do with the income support from the federal assistance. But again, as the cycle drags on, and to the extent that some of the federal aid is reduced, and it looks like it will be reduced, then I think those worries will come even more up front on the residential side. The commercial side, we know, is in a lot of pain, and the delinquencies on commercial-backed securities and the like are getting worse. So I think that's already started. The residential side, at least on some of the results, doesn't look like it started yet, but it probably will come.
Yeah. We got another question here, and this has to do with kind of the national debt and the impact that can have on our economy going forward. And it said, so the question is, if there's a further $1 trillion assistance from government with no increase in tax or other means to offset the spend, what can that do to inflation or further the impact to real estate?
Sure. I think, well, we'll take the second part first. A bout of inflation, if we get a spike of inflation for whatever reason, that will turn into higher asset prices and higher property prices. And so that would, if you own a property, that would be relatively good news. Now, whether we'll see that with further recovery efforts and stimulus and the like, the answer is probably not. We could, but I think the historical data is clear that if you borrow in your own currency, that the debt is not something we should be overly concerned about. Now there's got to be limits at some point. We don't know where they are. They're much higher than we previously expected. If you look at Japan, Japan's basically 10 years ahead of us on all fronts, from a demographic perspective and from a property bubble perspective and all that sort of stuff that they went through. They went through all this starting in the late 80s, early 90s. They have debt to GDP, 250% federal debt to GDP and the like. And they, in fact, they have problems with deflation, not inflation. So I think some of those concerns are misplaced. But at some point, you think there would be a fiscal capacity or some sort of constraint, which means that you have to be careful with your fiscal use. And so, saving people from a pandemic seems like a good use of federal debt. Maybe, tax cuts at the top of the cycle maybe would be less prudent use if we're worried about fiscal space, right? So it's keeping those sort of things in mind when it comes to federal policies. It's certainly, always something worth doing.
Let me see. We got a number of other questions on here, just trying to work through them and see what we might have already covered. See here. One of the questions, do you have figures on the percent of mortgages that are in pre-foreclosure? So just, is there any indicators right now in terms of how people are falling behind on their own personal mortgages and what that might do in terms of an impact to real estate?
The data from some of the mortgage monitors showed that there was a big increase in mortgages in forbearance, right? That went up to about 8%, going from, I don't know, 1% to 8% of mortgages nationwide. But that started to fall again. Actually started to fall the last couple of weeks or couple of months. Now, forbearance is different than foreclosure. And so I think, again, that the leading edge of that data is maybe the Fannie and Freddie. Was that the data that just came out that showed a little bit of an uptick associated with delinquencies, not forbearance, but delinquencies? So I think we're still at the very leading edge of that. Again, I think largely due to the federal assistance, the one-time recovery rebates we got in our bank accounts, plus the expanded unemployment insurance. So I think, again, not a ton of pain so far because of the assistance.
Yeah, thank you. Trying to roll through here. Is there anything else? You've talked a little bit about the opportunities for Oregon in terms of in-migration. And you mentioned just that Oregon remains an attractive place to live, and on the West Coast, it still remains more affordable than our other counterparts to the north and south of us. Certainly not affordable, but more affordable. Are there any other things that you think are going to impact immigration that could be a help or a hindrance in terms of what we're seeing on that? Because that's going to be a big part of kind of housing going forward as well too, is that continued immigration. Are there any other factors that you think could impact whether Portland is? And we've been known for certain types of industries. Have we been more susceptible to those, and those likely to kind of remain down, and that might impact immigration? Or any other things that you're seeing are going to impact that, which can impact housing?
Yeah, so people move for housing and jobs mostly, and then housing second. And so, you know, as job opportunities return, that should be, the people will follow. And so that'll be good news. Affordability is the risk, because if people can't afford to move here in the first place, then that would hurt our labor force growth and our economic growth more broadly, because businesses couldn't hire and expand as much. Now, our industries that have strength in, you would think, you know, are doing okay. Well, we seem to have some structural issues associated with our high-tech sector, with our largest employer facing some manufacturing challenges. But so long as they're continuing to invest in R&D and work on the manufacturing and design new chips, you know, that's still really good news for Oregon. There's always going to be some hiccups. The devolution of Moore's law and hitting some of these physical capacity constraints has clearly been real. But I mean, that would potentially be a risk. Our growing professional and business service class, particularly in the Portland region, you know, we will see. Some of that has been due to outposts and satellite offices from places around the country setting up, you know, local satellite offices and the like. So I think it's certainly worth monitoring those. I don't see anything in particular that would be at risk today, above and beyond normal cyclical activity.
Yeah, this doesn't impact, well, it could impact housing directly, but one of the other questions is we've just been getting more information over the last day or two about the likelihood of schools being online only in the fall. And one of the things that's had a big impact on, we've seen it with our own staff, and I know many of our members have as well too, is just the impact that has on people that are working, whether they're going into an office or working remotely and having to deal with childcare or kids at home that are school and all this. So I don't think there's real specificity to the question here, but it's just that will have some kind of an impact, and employers and employees are struggling with how they manage this new reality. And now it's looking like that's going to extend into the fall. So just any thoughts on the impact that will have, or what you're seeing, or anything in that area?
It's certainly going to be a challenge at best. You know, we did a report last week before, on the working from home and also broadband access and the importance there, right? So broadband is important for social reasons, staying connected to friends and family; economic reasons, staying connected to the labor market, applying and searching for jobs, communicating with colleagues, coworkers, interacting with clients and customers, and all that sort, right? Like, it's very, very important. if you're working from home. And it's increasingly important for education because we're going to do some sort of distance learning this fall, whether it's full-time or all-time, and maybe it'll last part of the school year, the whole, we don't know. And so, yeah, the internet and computer and technology more broadly is vital for all of those reasons. And the educational issue, there's a lot of inequities there, whether it's urban, rural, young or old, rich or poor, black or white. There's a ton of inequities when it comes to technology that are going to be barriers to overcome, and they're going to be significant barriers to overcome for some segments of our population. But as you were saying, that's going to feed through to the parents and the ability to work from home. Now that 1 in 3 workers can theoretically work from home due to the nature of their jobs. That's 1 in 3, whether you have kids or not. So the parents kind of have the same mix of occupations as the people who don't parents. So that's a large swath of the labor market that's going to have to deal with that to the best they can. So there's a lot of challenges, a lot of issues we're going to have to work through. But it all starts with the virus. We get that thing under control somehow. We get whether we wear masks, we suppress the virus, we get a vaccine next year, whatever the case may be, that's when things will start to get back to normal, is when the virus is under control.
Yeah, and I think that goes, another question I saw in here was then related to colleges. Colleges, if more of them go online, how will that affect the rental markets in those cities? I think it's kind of the same thing. That's why we're hoping this doesn't go more than several months into the fall, because it will. I mean, you're hearing a lot about that, where especially these large college towns, if they go more online, a lot of the rental market is given to students that are living there, and there's going to be some major challenges in those towns as well too.
Huge, right? Well, obviously, we have seen a spike in young people living at home again, and it's primarily going to be the college kids at first. And so I think that will continue. The other thing there is all of our friends in the higher education business will point out, it's not just the rental markets, obviously that, and the businesses associated with college kids in these towns. It's also the funding model for institutions of higher learning, where we have basically we've defunded them from a public services perspective, and we've increased tuition rates on out-of-state tuition, out-of-state students. That primary funding is international students and out-of-state students paying higher rates of tuition is how we've basically funded it. And so to the extent that, why would you pay these out-of-state tuition rates for remote learning? And so that is also another major risk here, would be the solvency of our universities. That's another thing to keep in mind beyond just the rental market and the businesses.
Yeah. We got time for a couple more questions. I see one on here. It says the next OEA forecast is due in September. Can you give us a sense for the range of increase or decrease in housing starts that you guys are thinking about?
So if you looked at our forecast that we released in May, we had a 20% drop in housing starts for about overnight due to so our initial thinking was overnight we see a 20% drop, and it takes about 2 years to get back, right? So kind of a smoother trajectory to get back, which is kind of not a great recession, but not a 1990s recession either. It's kind of in between. We obviously haven't seen that. I think permits are down 8% on single family side, 16% on multifamily right now. So significantly less drop than we were expecting, as we're talking about some of those reasons for that. So I think it's fair to say our forecast will be higher than it was, but I don't think we're going to put in a bunch of growth. I think we're going to put in more stability. But I think as long as some of that permanent economic damage is kept at bay, in terms of business closures, permanent layoffs, it's important to keep in mind right now, we still have a really high unemployment rate, right? Still in the double digits, 11% or so, 12% in Oregon, somewhere in that range. If you look at the data, 90% of that increase, 90% of the increase in the unemployment rate is temporary. They're classified as unemployed on temporary layoffs. So as long as we can keep that relatively permanent share low, I think stability would be the key word, right? Ongoing stable levels of output and home sales and the like, for all the reasons we discussed today. To the extent that the recovery drags out and we see more permanent damage, more income losses and the like, then we'll start to factor in, more larger declines or for a more protracted period of time. So I think if I had to say today, our housing starts forecast will be up because we had built in a larger decline than was probably warranted. We overshot the downside associated with that. So kind of a either or discussion, I'm sorry.
Okay. One of our elected officials in Washington County asked about, I realize they put you in a tough situation, but we'll at least throw it out there about taxes, new local taxes or taxes in general, or require anything like that that will impact the building industry as well as other types of businesses. So obviously there's been, the corporate activities tax was approved. There's been a lot of consternation over that with businesses hurting. Our metro region has had several new taxes. We've got the supportive housing services bond tax that got passed this spring. We got a transportation one this fall. So without trying to get into whether someone is for or against taxes, just in general with what's going on here, is there anything that you guys are looking at in terms of how these taxes are going to impact potential business recovery or just businesses survival through this?
We don't, we don't have any good information. I think, particularly on the corporate activity tax, it's so new, right? We've had the second estimated payment is due tomorrow, right? And so, or due on Friday, I guess. And so we've had one quarterly payment, no tax returns, right? Just an estimated payment coming in the door. And so we don't know anything about it. We don't know who exactly is paying it. Well, we do, but we don't know exactly what it means for the underlying sales. It's a brand new tax that came into effect right as we went into a global pandemic. So it's going to be a while before we sort that out, but there's a lot of stuff on the research agenda to get at what the impacts will be on the economy, the level of pyramiding across industries or within industries, and the like. And so that's something we're certainly going to be looking at in the years ahead, but we don't have anything important to pass along to date, other than, we have some previous reports from the state of Washington with their B&O tax and some of the impacts there. And we're going to replicate that for Oregon again, but it's going to be at least a year. So that, the big issue immediately was cash flow. And so making sure, most of our taxes, they scale with the economy, right? They're some of these tax increases, the marginal taxes, as your income goes up, you pay higher on the income side of things or the like, or the gross receipts tax is based upon your level of sales. So they scale with the economy, but given the immediate shutdown nature of the pandemic, I think the risks are primarily on the cash flow side of things. And so, to what extent, taxes hurt cash flow in the immediate term is something that would be worthwhile considering, but I'm not entirely sure how we'd go about measuring that risk. Yeah.
Well, thank you, Commissioner Rogers, for that question. And I guess I'll do a last question before I turn it back over to Nathan Young. This comes from Mayor Knapp. Is a Metro-led effort for more affordable housing units having any effect on the building construction industry? And is private construction moving in any significant way toward building more affordable units? And that I don't think you're probably tracking all that stuff, but I don't know what you may or may not be tracking. But is there anything that you're seeing with Metro's bond on this affordable housing units and that construction that's having an effect on the construction industry? Or is that not anything you've really had a chance to delve into?
I haven't had a chance to dive into that, right? And so I just have some talking points about our general nature we've had in recent years, right? Where, you can't build new construction in the private market for people at 30% of area median income, right? That is, or 50%, even 70%, right? Like it just doesn't exist. So you can't do it with cost. And so you need that public assistance. Unfortunately, there's not enough public dollars in the world to solve the entire need. Right. Now, every dollar helps. Every unit counts. That's one less family that's hurt as badly by the housing market. But it has to be overall a private sector solution, ensuring that adequate supply every single year, so then that we do get some of the filtering activity to provide better affordability for our middle income households and the like. But yeah, it's certainly something we'll be paying attention to moving forward. Our counterparts at the city and the county are probably better able to track that in real time than we are.
Yeah. Well, thank you, Josh. I'm going to turn it over to Nathan so he can wrap up. I did see one question on there that said, and hopefully the rest of you saw it as well too, that asked if we were recording this. And yes, we are. And both the recording and the slides will be available on HBA's website later today. So Thank you, Josh. I'll turn it back over to Nathan so he can also wrap this up and thank everyone.
Great. Thank you, Dave. Thank you, Josh, for giving us a look at what's been happening in the industry and a projection into the future of our market. Thank you, Northwest Natural, as our presenting sponsor. Thank you to all of our attendees and for non-members out there. We would love to have you become Home Builders Association members. Our membership team is here to give you more information about the many financial benefits of becoming an HBA member. The work of our membership encompasses the entire residential construction industry, from apartments and remodels to triplexes and single-family homes. We are dedicated to increasing the affordability and availability of housing for our residents. This is summed up in our tagline: housing affordability, housing livability, housing first. So just call the HBA office today and we can put you in touch with our member concierge. Now, on behalf of everyone at the HBA, we thank you for joining us. Have a great day.
Thank you all.